Hello, this is Alex Voikov in for Ann Jones, and I'm pleased to welcome you to today's webinar. Dmitry Pugachevsky will present comparing alternative methods for calculating CVA capital charges under Basel III based on standardized and advanced methods. Dmitry is responsible for managing Quantifi's global research efforts. Prior to joining Quantifi, Dmitry was the head of counterparty credit modeling at JP Morgan. Before JP Morgan, in 2008, Dmitry was the global head of analytics of Bear Stearns for 7 years. And prior to that, he worked for 8 years with analytics groups of Bankers Trust and Deutsche Bank. Dr. Pugachevsky received his PhD in applied mathematics from Carnegie Mellon University. He is a frequent speaker at industry conferences and has published several papers and book chapters on modeling counterparty risk and pricing derivative instruments. Actually, if you're in London, Dmitry will be moderating a panel on CVA at a premiere session next week on Tuesday evening at the BBA. Dmitry, can you give us some details on the panel that you'll have at the event?
Yes, sure. We will have a great panel where we talk about regulatory issues, latest accounting standards, on FVA debate, on challenges in implementing CVA coming from both computational side and quantitative side. So basically we will try to cover a broad range of issues, and we'll be happy to see everyone there.
Great. If you want to join, you can find the details on the London chapter website, and it's going to be next week, Wednesday, 6:30 p.m. at the British Bankers Association. Please feel free to submit your questions to the presenter via the question pane, as usual, on the right-hand side of the screen during the presentation, and we'll moderate the audience questions at the end of the session, and Dmitry will be answering them. So now, Dmitry, I'll turn the presentation over to you.
Thank you, Alex. Good afternoon, everyone. Thank you for joining us. Today we are going to talk about Basel III CVA capital charges. They come in two flavors, standardized and advanced methods, and we will talk about this at length. So first we'll cover a little bit what's new in Basel III related to CVA capital charges, and there is the new well, kind of separately defined CVA VAR or CVA market capital charge, and as I mentioned, it can be calculated either using standardized formula or advanced formula. We will look at both of them and compare them. Then we will look at test results for a very simple case of interest rate swap and see how basically these capital charges the results of this calculation for this simple case. And then we will talk about hedges. Basel III allows to hedge credit risk to alleviate some capital charges. So we will talk how this works and look at the test for a real portfolio. And this presentation is based on a white paper which we wrote with John Gregory in October 2012. It's on our website, so if you are interested, you can get it from there. Basel III, the draft was issued December 2010, finalized June 2011. And in Europe, it's implemented using CRD4 now, which was supposed to come in force this January, but now it's postponed by January 2019, or it's phased out, and there is still a lot of unclear and uncertainty about liquidity, CFIs, and all other issues. And here in US, also Fed issued very brief kind of release on November 9th, where notified that Basel III will be postponed, in the sense that this new capital buffer calculations, which were supposed to start in January, will be now postponed, and they cited a wide range of views. I probably believe more that there were very strong views expressed in terms of how expensive will be this capital. But we will talk today about just one part of this Basel III new capital charges, which is CVA risk. Sometimes it's called CVA market risk, CVA VAR. It's all the same. Just a little bit of history. Basel II, which was still under implementation in many banks, but which was published in June 2006. Basel II already had capital charge regarding provisions for counterparty default in the form or RWAs, risk-weighted assets. But during financial crisis, like having capital against these RWAs wouldn't really do many banks much good, because what happened that losses were happening during the crisis not really from defaults. Only 1/3 of losses came from defaults. Mainly losses which banks incurred, they were coming from CVA swings, because before the crisis, banks already started reporting CVA. It was part of the accounting standards, and what happened during the crisis with credit spread widening and with shocks to basically all market parameters which we experienced, these CVA results were much higher than they were before the crisis. And CVA, as we know, is the charge, so it's growing CVA means that banks are losing money. So Basel III recognizes basically this problem and introduced new capital charge against this particular problem, against CVA volatility, which, as I said, can be calculated using either standardized or advanced, and both formula are described in Basel III. We will look at them in detail. Also, Basel III recognizes credit hedges, so these CVA swings can be moderated, can be hedged against using credit default swaps, contingent CDSs, which are not really traded these days, and CDS indices. CDS indices were added only after discussion with the industry. Initially, they were just single names. What's interesting that hedges against market risk, against interest rate effects or equity risks, they are not allowed by Basel III, not recognized as hedges against CVA VAR. So desks which have this hedges against CVA movements, they now have to kind of they incur a separate charge because these hedges go through the other VAR process, and instead of alleviating kind of capital charges, they add to capital charges. But that's where we stand now. So we will look at hedges under both approaches and analyze basically what is the optimal way of calculating hedges and what are the optimal hedges for each approach. This is the nice graph which we actually copied from Moody's, but this allows you to visualize basically what is the new, and what we are looking at is this circle new. In green we have new Basel III capital charges, and this CVA is added on top of what existed before. All this in gray to the left of CVA is RWA Basel II capital charge, which, as I just mentioned, was capital which banks had to hold against defaults. And the new capital charge CVA VAR is against CVA movements. There is also WWR right below CVA, which is wrong-way risk, which is also, it was kind of mentioned in Basel II. In Basel III it was well defined. both specific and systemic wrongware risk, and Basel III defines how to deal with this, but this is outside the scope of this presentation. So though we wrote some paper which is also available on our website where we talked about wrongware risk and regulatory charges related to it. So let's talk about standardized CVA formula. This is simplified calculation. It allows to do everything basically in Excel in one calculation. And if we go from left to right, so first this is 2.33 coefficient, and we will talk, actually it's pretty significant coefficient. Then we have square root of h, but h is set at 1. And then we have square root of some expression, and under this expression we have summation squared, which look a little bit as a calculation of variance for portfolio of some normal variables, and we will talk about this as well. But what is inside here are WIs, so if we go again from the left to right and look at the notations, WIs are weights of ith counterparty based on ratings table. Then we will see MI, this is effective maturity, and then EADI. Total here means that AD is exposure at default. Both MI and EADI are defined in terms of Basel II RWA charges. They were introduced there, they were described there. Basel III did a little bit of maybe improvements or a little some amendments in MI, especially for example, like in Basel II maturity was kept at 5, but in Basel III it's uncapped now. It's also discounted. So there are some differences, but main kind of notion comes from Basel II. Exposure at default total means that it's for the whole total netting set corresponding to ith counterparty. And then we have MI hedge and BI. So MI hedge is maturity for CDS hedge, single name hedge, and BI is its notional. And after this, we see this different summation over IND. This is the index hedge which is applied to the whole portfolio. So index hedge is calculated, is applied not to one counterparty, but to the whole portfolio. So basically here we see like CVA for the whole portfolio consisting of many counterparties. We go to the next slide, and where we kind of try to explain and get some intuition of this formula, because this formula was given without any kind of explanation. Here is just standardized CVA, but this 2.33 gives us some hint, because basically this is a quantile, 99% quantile for standard normal distribution. So basically we can treat the whole formula as 1 year 99% VAR of some portfolio of normally distributed quantities. And the only thing which we know about these quantities is that they have some specific volatilities, and here we can extract these volatilities. So each volatility is W multiplied by this expression in brackets. And also if you rearrange terms in this under square root, one can see that basically correlation structure is also specified. And this correlation structure is that correlation between each counterparties are 25%, and between counterparty and index it's 50%. So that's how this formula can be interpreted, can be translated, interpreted, that this is 1 year 99% VAR of you can think of this as like portfolio of assets. Each is normally distributed with zero mean and this volatility, and volatility sigma I with correlation 25%, also has hedge which is correlated 50%. This is kind of important because we also look at the advanced CVA formula, and advanced CVA formula is explicitly expressed as a VAR. It's not 1 year VAR, it's 10-day VAR, but we know this is just it's up to a multiple differences, just to multiplying by coefficient. But this is now also 99 CVA VAR. Moreover, it's not one CVA VAR, it's sum of 2 CVA VARs, and then they are multiplied by 3. So let's talk a little bit. First of all, not every bank which can calculate or can use this advanced CVA formula. First of all, this bank should have IMM approval for RWA. And second, this bank should have specifically approval for specific interest rate risk VAR model. So this CVA VAR calculation, they are done consistently with how bank calculate interest rate risk or for bonds, basically bond risk VAR model. But one can see that this CVA VAR have upper index or cure and stir, which means current and stressed. So first, current can be calculated CVA VAR based on historically most recent period, and stressed should be calculated on historical stressed period. And this stressed period should be chosen as a stressed for the whole portfolio, not for this particular counterparty. So it can happen that for some counterparty stressed will be actually less than current, but in general, of course, the stressed CVA VAR will be higher because one has to choose like more stressed historical time. It's a little bit puzzling why this formula looks like this, because, for example, if you look at also Basel III recommendation for calculating RWA, now you have to take maximum of current period and stressed period. But in CVA VAR, it's not maximum between two, is summation, and also multiplied it by 3. So it's maybe a little bit overkill, but that's where it stands now. Now, in addition with this formula, Basel III wrote a recommendation for calculating CVA. And here we probably have to pause a little bit and look at this and discuss this in more detail. So first term is LGD, which is taken from the market. And then we have some expression under maximum, max with 0, and then 2 exponents. But I will explain the meaning of this, intuition of this a little bit later. And the last term is basically average of discounted expected exposure from the beginning of the period and from the end of the period. Actually, when industry got this formula, there were no complaints about this, because this is pretty close to how CVA is calculated by front office desks. Because CVA is basically discount expected exposure multiplied by default probability in the interval. And we see here average expected exposure discounted. So basically this term, maximum 0 and then difference between 2 exponents, is exactly this. It's difference between 2 survival probabilities from the beginning of the period and end of the period. And this difference has the meaning of default probability in this time interval. why it looks like this? Because why, for example, we have max with 0. We know that survival probabilities are non-increasing, non-increasing function. So in principle, if you take survival from the beginning and subtract survival to the end of the period, you shouldn't have negative number. But Basel III recommendation, they basically try to avoid bootstrapping of credit curve, basically building credit curve from the market spreads. So they came up with this simplified calculation of survival probability based on CDS spread. SI is CDS spread corresponding to this counterparty to this time. And this works pretty well when the spreads are flat. It's almost exact, but when there is term structure of spreads, when they change in time rapidly, then we can get some kind of difference of these exponents can become negative, and then why this max is necessary. So nevertheless, this formula is it satisfied the industry, and most probably important is that Basel III explicitly recommends using market spreads, SI, and also market loss given default. So these quantities are coming from the trading. LGD is 1 minus recovery, and recovery is defined by traders for each counterparty. So this formula is based on market traded quantities, which wasn't that clear, for example, in accounting for CVA and DVA. So there are still, I believe, debates which spreads to use for DVA. Basel risk-neutral spreads or historical spreads of default, but Basel specified exactly that if this is traded, you have to use it. If not, then you have to come up to proxy, but proxy again based on market traded spreads. So standardized formula is more simple and supposed to be more punitive, but there are examples where standardized formula produce less capital charges than advanced. And we will show this example and explain what are these cases. And we start with very simple interest rate at the money swaps, 100 million USD, different maturities, and we consider two counterparties. One which has spread 100 basis point and rating AA, and another 300 basis point and rating BBB. And we will consider advanced method, and for standardized method I probably have to comment here, or basically we have it on the slide, that when you calculate effective maturity or exposure at default, you can follow one of the Basel II methods of calculating them. And these methods are CM, which stands for current exposure method, or IMM, which stands for internal model method. CM is simplified calculation. There is also standardized method, standardized for Basel II, but we leave it out of scope of today's presentation. We have another white paper which compares all the approaches and also look at SM. Here we talk just about CM and IMM. So CM, it's a simplified method, and it has a deficiency that it doesn't take the whole netting and the whole collateral into account, but sometimes it produces better results, and we again show it here. So for standardized, we consider two ways of calculating EAD and maturity using CM or IMM. And just to comment, IMM, which is internal model method, is based on Monte Carlo, so it requires basically as much effort as advanced CVA. So if you have IMM, then you can produce your CVA because IMM is based on, it's also exposure-based method. So now we see the graph. We see 6 lines, 2 red, 2 blue, and 2 green. And greens, they correspond to standardized CM, blues to standardized IMM, and red to advanced. So first, one can see immediately that standardized CM in this case gives, and what we plot here are capital charges, so that one can see that standardized CM basically requires using this produces least capital charge, and the reason for this is that this is very kind of a case which is very favorable for CM. First, because it is interest rate, and the second, because it's at the money. So CM is based on exposure, so exposure is 0 here, and then you just add on some percentage of notional, and for interest rate is just 1.5% of notional. For comparison, for equity, it's 10% of notional. So in this case, and there is no netting and collateral here, which we know is pretty poorly reflected by this method. So that's explanation why CM looks so kind of looks better than others. Another interesting point here is that one can see that difference between counterparty and counter 1 and counterparty 2 is the biggest for advanced method. So it jumped like almost 4 times, while for other methods it jumps only, I have it here, 43%. And explanation is that when we look at counterparty 1, counterparty 2, if we go back, one first has 100 basis point spread, another 300 basis point spread. So it's roughly, so its spread is 3 times higher, which means that CVA will be 3 times higher. Also, volatility is 50% higher for this second counterparty. So we would expect to have CVA VAR like 4.5 times higher between first and second counterparty, and we see it here. But for a standardized method, the only difference, if you look at the formula, and we can do it now, the only difference between 2 counterparties will be in this weight W. And this weight changes for WA, it's 0.7%, for triple B it's 1%. So the change is only 43 from 0.7 to 1. So that is reflected here for blue lines or green lines. The jump is only 43%. So that means that for high rating but also high spread counterparties, advanced method can produce sometimes pretty high CVA VARs. But to be fair, we also compared this for in-the-money swaps, and they are not hugely in the money, like fixed is only like 25% higher than floating, and we immediately see that CM moved up a lot because it's based on exposure. So one can has to remember that all these calculations are very kind of depending on the portfolio, on the exposure, on markets, and so on, and that's very, very dynamic. We cannot really make conclusions based just on these calculations, but nevertheless it gives some flavor of capital charges for each case. Now let's talk about hedges. So I mentioned already that Basel III allows single names and also indices as a hedge against CVA. And how we can apply this in our calculation. So for advanced CVA, where we use the formula for CVA, and you remember this formula as LGD, and then we have LGD, and then we have probability to default in the interval, and then we have kind of average expected discounted expected exposure. So we can rewrite CDS payment on default leg in a similar form. So basically when protection leg, so there's also fee leg, but if you buy protection, then that's what you expect to, or that's how you measure your value of protection. It's also LGD multiplied by notional. Then you have kind of average discount, and then you multiply. Of course, front office use here real survival probabilities, but we should follow here Basel III, so we put default probability in the interval in the similar kind of form, and then we can combine them, and then we can get CVA hedged, which will be LGD of or 1 minus recovery of counterparty. And then what happens if you compare with the formula for CVA, we reduce expected exposure by CDS notional. This is for kind of just one CDS with one maturity applied to this counterparty. It's probably more popular way of hedging is to apply several, they have different maturities, different notionals, give kind of better hedge against exposure, because one can see that if notional is close to exposure, then your CVA, hedge CVA will be close to zero. So keeping kind of notional of CDS close to exposure is at this interval is what front office is trying to do. But interesting conclusion is that here that optimal strategy of if you try to get optimal hedge for your CVA for capital relief, it will be similar to strategy, hedging strategy which desks are using. But that will be different from if you use not advanced, but if you use standardized formula. And one can go here and see that basically in standardized formula, BI is the notional of your CDS hedge. So if you choose a maturity of hedge similar to maturity of your kind of effective maturity of counterparty, then your BI should be close to exposure at default. So that means that for standardized, your CDS hedge will be close to exposure in default, and for advanced, it will be close. It basically will be close to your average exposure, which this difference reflects difference between delta neutral hedge. So advanced, if you calculate your delta neutral hedge and apply it to advanced formula, it will work pretty well. But it won't work that well for standardized. For standardized, you have to come up with a different strategy. As I said, you have to choose your exposure closer to exposure at default. And we choose some realistic example. We set up portfolio of trades, several counterparties, and calculate standardized. In this case, just IMM method, because CM won't work well at all here, because we have real netting, real portfolio, and also real exposures, not at the money. And we graph this standardized versus advanced, and this is the result. So if there are no hedges, then standardized capital charge is slightly higher than advanced. That's we saw that they can be comparable. Then if we apply index hedge, then advanced goes down and standardized goes down. Advanced goes down much more because, as I explained, in this case we calculated notional of this hedge using delta neutral strategy, which works much better for advanced. But still, one can see that index hedge didn't really decrease capital charge that much. The reason is that it's still index hedge, so it's based on the on movements of many credits, so correlation is not 100%. So decreasing of your capital charge is happening, but not as much. But then when you apply single name CDS hedge to this portfolio, so we have several counterparties, so you choose for each counterparty delta neutral CDS hedge. Again, it's not ideal. It doesn't reduce it to zero because it's just one CDS hedge, but exposure has profile. So as I explained, to kind of completely eliminate CDS movement, CVA movement, one has to take like term structure of take into account top structure of exposures and have several CDSs with different maturities. But nevertheless, one can see on the furthest to the right part of the graph, when you apply CDS hedges, advanced is reduced significantly, while standardized still is pretty big. And this shows that this delta neutral strategy, which CVA desk are using anyway, works much better with advanced formula. That's basically what I explained. You can read this, but one thing we have to remind you, you have to keep in mind that basically there will be no perfect hedge for, even if you take the whole kind of term structure of hedges from CVA desk and apply it to your CVA VAR calculation, it won't be perfectly hedged because even in advanced approach, because CVA VAR uses stressed parameters, and that's also kind of reflects in this calculation. So even the hedge which hedge completely CVA movement for the front office won't hedge here because of second part like stressed VAR and so on. Another thing which we have to keep in mind is that single names are not that liquid, and liquidity actually is drying up, and maybe index hedges will be the only hedges which will be used for alleviating CVA risk because of the costs which are associated with trading single name hedges, and that transaction costs become pretty big. So the conclusion is that there are two methodologies to use to calculate CVA VAR, and banks should strive for more advanced methodologies because they give them better capital relief, they give better netting, they give better collateral treatment, because even IMM, which is used in standardized formula, requires better model, Monte Carlo model with calculating of expected exposure. When it comes to hedges, single hedges works much better if you use trading strategy. It works much better with advanced method, but again, because of liquidity, maybe index hedges are the best. They still work better with advanced method. So we also would like, that's it on this presentation. And I will open Q&A session in a second, but we also would like you to answer 3 poll questions, so I will read them, and while I will answering your questions, maybe you can do the same and answer our questions. So what do you consider to be the key component for an effective counterparty risk solution? A, data management, B, advanced analytics, for example, wrong-way risk, C, performance and scalability, D, asset class coverage, and E, collateral management.
Thank you, Dmitry. Let's give about 10 seconds to the audience so they can vote.
Yeah. I was asked to give 10 seconds for you to absorb this and choose A, B, C, D, or E, and then we will move to the next one.
All right, I'm going to close the question. Let's move to the second one.
Right. Yeah, and actually we will see some statistics, and we can talk about this in the end of this. After Q&A, we can talk about what the results and what's interesting. Second question: who is responsible for the management of CVA within your firm? Central CVA desk, trading desks, credit risk department, or multiple groups?
Okay, let's move on to the third one.
Okay, and the third one, Basel III includes a number of measures to improve risk management. How prepared is your firm to meet Basel III requirements? A, complete Basel III solution in place. B, Basel III solution is in progress. C, have not started but plan to. D, have no plans for Basel III.
That's great. Thank you very much for voting, and thank you, Dmitry, for taking us through the world of formulas of CVA. There was an FVA debate, funding valuation adjustment, at the end of last year. Can you outline what was the nature of it, and which side would you take?
Okay, yeah, with pleasure. It was really the debate of the fall of, it actually started in July, I believe, but it touched kind of really the nerve because it was the question what to do with funding valuation adjustment. So even calculating FV is, I don't think industry settles on how to do this, and quants are still going through different methodologies and so on. So funding valuation adjustment, it arises in a case when the trade is done, for example, over the counter. It's uncollateralized trade, but to hedge it, bank goes to central clearing, to central counterparties, and there when a trade is positive, the hedge is negative for this bank. Bank has to put margins, and to do this, bank has to borrow money. And bank borrows at LIBOR plus spread. But when the other kind of situation, opposite, occurs and bank receives money on margin, bank can only invest at LIBOR. So this asymmetry that bank borrows at LIBOR plus spread but invest at LIBOR, Even LIBOR you can kind of argue is not really a risk-neutral rate, but I still kind of mention stick with LIBOR. So this kind of leads to the new cost which has to be taken into account. This is the cost of funding. It's proportional to bank credit spread. And before crisis, it was usually kind of ignored because spreads were pretty low. But you cannot ignore this now, especially when banks had like spreads 300-400 basis points and higher. So this is definitely the cost. Again, how to calculate this, it can be debated, but the debate which Alex referred to was what to do with this cost. So now that you know or you agree within your bank how to calculate this, will you try to pass it to counterparty of your trade, or will you try to apply to your trading desk, or you just ignore this completely? So first about, can you pass it to counterparty? And here people refer to CVA and DVA, which was basically included in the price. But that's the point. When you have CVA, you have DVA. These are two symmetrical, two sides of the same. One counterparty CVA is another counterparty DVA, so they subtract each other. They might cancel each other. So that's both banks kind of agree on this, on including this, and that they cancel each other, so it's symmetrical. FVA is not symmetrical, so this is the funding cost of the bank, and the other bank incurs the same cost, not the same, but a similar cost. So it's not, they both have this cost, and they cannot really cancel them. So passing it to the counterparty probably won't work very well. It probably will lead to widening of margins, because you at least some of the costs you will probably try to compensate for by getting a better bid offer if you can. But this cost is real. It cannot be ignored, and it should be, in my opinion. So the other question was, okay, if you cannot pass it to the counterparty, should you just if you cannot include in price, should you think about this at all? Should you charge traders for this, or you have to ignore and pretend that it's not there? I think original idea or original paper by Hal White in July basically was saying that because it cannot be justified from risk-neutral pricing, this FVA, it should be ignored completely. It shouldn't be taken into account, and that caused a lot of complaints, or there were strong opinions from risk managers and from traders who basically the different opinions were like to charge desks or not, but if this cost exists, then in my opinion you have to do this. You have to calculate it in some kind of by Treasury probably, the department which deals with funding cost of the bank. Ideally, if you also can, if this department can also deal with CVA, DVA, because DVA is also based on banks' own spread. But I disagree with the point that this is double counting. CVA and DVA is one part. It can be part of the price, but FVA is the cost which is separate. And basically, Hal and White wrote another paper in October, also in Risk, where they agreed that it should be kind of taken into account as a separate cost, but still shouldn't be part of the risk-neutral pricing. And I agree with this completely. It cannot be derived from risk-neutral pricing. It basically comes from market incompleteness, but it's not the first time. We deal with market incompleteness all the time, like jump in prices or costs of hedging transaction costs. We know that they all eat into Black-Scholes pricing, for example. So those who trade based on Black-Scholes price, they have to take this into account, these costs. And this is similar thing. Maybe difference is that FVA probably is much higher now than it was before. And second, it can be quantified better than other market incompleteness. So yes, I think that it is a cost. It should be charged to the desks, and basically banks which have better credit spreads will probably will charge less to their desks and will have more profitable trading. That's in a nutshell.
So it's not going to disappear if we close our eyes. It's been announced that Société Générale and some other institutions are looking into securitization of counterparty credit risk for capital relief. Do you think this is going to be the trend in the near future?
It's hard to say because the main reason to do this is to get, as you said, capital relief. But at the same time, we saw that Basel III states explicitly that the only hedges which will be allowed will be single name CDS or index, so very well defined credit products. Even CCDS, though it's mentioned, but I don't think it's very liquid or were traded much, though is the terms exist for a couple of years now for interest rate swap. So I don't see how these banks can get capital relief, can get agreement of regulators to give them capital relief on Basel II and III. And another question is, who will be the other side? Who will take this? Who will give this insurance to the banks against this counterparty default? Because basically it can come to the situation which we had pre-crisis when company like AEG was selling protection on very poorly defined instruments, credit instruments like tranches and so on. And with counterparty, I believe SocGen was trading not the whole counterparty risk, but some tranches of counterparty risk. So that basically requires you to take into account correlations between defaults of different counterparties, but also if you have wrongly risk between counterparties and market factors. So it's very, very challenging from the point of view of calculations. You should have very good models to on both sides, banks and the other sides, which probably will be big asset management or some hedge fund. So you should have really good models to do this, and you have to agree on this calculation. And this other part should have a lot of capital to basically to show that they can handle some systemic event when several banks. So if it becomes the trend, then many banks probably would like to offload their counterparty credit risk, but who can take the other side? It's not clear. So for now, I think it's just one-off. And once again, it's not quite clear what regulatory capital relief they received from here.
Right, we're going to be looking at this closely because it feels like we're going back to mapping copulas on copulas and getting some inexact results. And I don't want to imagine what would happen in case of contagion.
Even worse, because when we dealt with copula, at least we didn't think about FX or interest rates and so on in general. But here you have to, because you have exposure which is based on all these market factors.
Mm-hmm. What do you think about the cost of clearing, so the collateral FVA? How do you think it's going to affect counterparties who can trade both OTC or through a clearing house?
Right. So central counterparties, and they basically are recommended or mandatory for banks. I think it started this Monday for swaps, for trading swaps, and by Dodd-Frank. And that immediately creates another problem. It's cost of margins. You have initial margins, which actually still not public how clearing houses are calculated initial margins. Of course, the bank knows, but it's hard to get for example, to replicate them. And it's not only initial margin. You have to take into account variation margin, which is like the cost of the capital which bank has to post during the whole life of the trade. So I think this has led to the new kind of cost, which people call marginal FVA, or so you have another FVA, and because it depends on cost of capital for this bank, but now coming from the putting margins for these trades, and it becomes an issue. So it's hard for us, for example, to quantify them, because, as I said, formulas for calculating IM and VM are not public yet, but they will be significant. That create will create problems, and for corporate, which can be exempt, and there is also sovereigns will be exempt, at least in Europe. That's what we heard, and pension funds will be exempt, some corporate. So there will be counterparties which will have an option either to stay over the counter, but then they have to pay all this over-the-counter charges like CVA minus DVA, FVA cost, and Basel III capital charges, or go through clearing where there will be no counterparty credit charge, but there will be a cost of margin. And I think there will be like having good models is important, because then each corporate can basically compare the cost and decide what to do and where to go, because with the current cost of capital, this both costs can be significant, and it's important to make optimal decision based on a really good calculator.
Good point. Can you give us some more color on who calibrates the market loss given default in the advanced formula?
In the advanced formula, it's coming from the market. It should be consistent with your CDS calculation. So this is your CDS is basically a 1 minus recovery. So LGD is 1 minus recovery, and recovery is available for traders, or at least assumed by traders. There are some trades like recovery log, but I don't think they are liquid now. But also the point here is probably that probably this taking LGD as 1 minus recovery is initial step. Then you can argue that maybe CVA debt is on slightly different level than CDS debt, so you might put some kind of correction to this and so on. I think this is kind of a subject of discussions with between banks and regulators, what exactly to use, what correction you can take to this 1 minus recovery of CDS. And again, if this name is not liquid, then you have to kind of proxy this LGD by looking at similar all LGDs of similar counterparties based on geography, based on sectors, and similar stuff what we do for credit spreads.
Mm-hmm. How do you think that the optional termination provisions will be treated in the advanced CVA calculation method if we're still in that formula?
If it's bilateral, then basically you just have to truncate your CVA, so you have shorter exposure. That was basically the idea. If there is unilateral, that can create some problem, and there were some papers published on how to calculate this, because then you have also to take CVA at time of this termination into account. But I would think like it's better to think in simplified terms, like basically this optional termination will reduce maturity and reduce exposure.
Mm-hmm. Let's go back to the standardized CVA formula for a second. Would you have used a different assumption for the distribution of returns there?
Can you be specific which returns?
Yeah. If you would have designed the standardized formula, would you have used something different than the normal distribution?
Oh, now I understand. It's an interesting question. I don't want to create something which is more complex than Basel III. I think we have a lot of, yeah, there might be probably some tail risk which you would like to take into account. So we all know like a critique of VAR, right? So you can take any kind of article by Nassim Taleb and have as much bad words about VAR as you need, but
on paper.
yeah. Oh, okay. But nevertheless, that it's 1% CVA VAR for normal, and how symmetrical it is, how you should take this into account, the tails of this. That's good question. Should you take this in this form, like, or should you take as expected shortfall? That's actually another interesting question. I didn't think about this. So, but that's what Basel III decided. So, and as I said, make it more complex. I'm not sure if it's in our interest.
Right. Let's look at netting for a second. Within a netting set, is it possible to net different derivatives and different assets from the same counterparty?
It's not only possible, it's necessary. That's what we do when we calculate CVA, and so that means that it goes into standardized as well when you calculate exposure at default. This total means that it goes per netting set. So if you have netting agreement and if you have a high confidence in that this netting agreement will be honored at time of default, then you have to do this. Maybe the question is in terms of calculation, how to do this, but that's why we have to run big Monte Carlos that basically where we simulate all market factors so that we can do netting for derivatives coming from different asset classes. So we, in one kind of shot, in one Monte Carlo simulation, we do FX rates, credit, commodities, equities, everything that allows us to net it. And that's why it's important to have centralized system because in some banks each desk calculating their CVA separately, and then of course it's impossible to net. So they basically are conservative in terms that they add the CVAs without netting and get basically higher CVA than they're supposed to.
Mm-hmm. And what do we do if the maturities are different? What's the standard practice there?
Maturities, yeah, basically you run your Monte Carlo till the longest maturity, and then you add or net all the trades based on, basically you do it for each time slice. You see what's your exposure at this time, so all the trades which still exist at this time, you just add them, and that's kind of pretty natural.
Very good, thank you. So our last question for today. Can you give us in a nutshell what's the thought process behind the cost-benefit analysis on using either a single name CDS hedge or an index hedge?
Okay, so I can probably repeat myself, or maybe just emphasize again that so if you look at hedging just one counterparty, then of course, or here we have two counterparties, but we applied two CDS hedges, one for each. So of course, when your CDSs are available, if they are liquid, then applying CDS hedge for each counterparty, single name CDS hedge for each counterparty will give you better results. And actually in both cases we can look in this case, or if you go through standardized formula, you also can match your notional to exposure at default and basically reduce this term to zero. While if you look at index hedge, this is term summation over int, it's applied to the whole portfolio, so you won't be able to match your notional of your index kind of exactly with single counterparties and so on. But there are market realities, and market realities are that there are not that many single name CDSs which you can apply to your broad portfolio. We have this basically requests very often to look into illiquid counterparties. It's a very big issue, especially in Europe, for European banks like German banks, which have a lot of counterparties, smallish banks or corporates or farmers even. And you have to price CVA for trading with them, but there is no credit spread and so on. So you have to find a proxy for this, or to use index, which probably is a better kind of coverage, or is a better proxy for the whole portfolio. So it's probably a good subject for the next research to have really kind of broad portfolio of names, maybe based on some geographical kind of, maybe take counterparties from some bank and just look at how index will hedge them. And so index hedge is cheaper. We know it's more liquid, and it can give you better kind of better hedge in the sense that it covers more names. It kind of gives you better movements in terms of systemic risk of your portfolio. So that's an important thing, is to hedge against systemic, which index does for you.
Well, let us know when the research is ready, and we'll arrange another session.
Okay.
Let's look at the polling question results a little bit here. So on the first question, I'm going to read them out for your benefit. What are the key components? What is the key component for an effective counterparty risk solution? 90% said data management, 38% said advanced analytics, or like wrong rate risk. 15% shows performance and scalability. 15% shows asset class coverage, and 12% shows collateral management.
Okay.
How does this match with your
So can you say data management is how much?
19%.
19, right? Interesting. So so advanced analytics is 38%. It's kind of nice for us. For me, as being on a quantitative side, that means that what we are doing is really important, at least in opinion of people in audience. So thank you. we kind of aware, of course, on of all other issues and so on. But yes, advanced analytics is something which we as a group or other groups are looking at, and wrongway risk is just one example. Collateral treatment and kind of close-out events are another interesting issue which covered by advanced analytics. And calibration, it becomes also a big issue, right? Where do you get your data, especially, as I said, for liquid counterparties, correlation for wrongway risk, where do you get them? And everything comes from this correlation. You get correlation 0, there is no wrongway risk. If positive, you get. If negative, you get right-way risk, right? So it all comes to this kind of single piece of data, but where do you get this? This is a very interesting issue. So yeah, that's interesting results, but they kind of go along our expectations.
Can you give us a very quick example of a very tricky wrong-way risk situation?
Tricky. The most, yeah, I can, basically wrong-way risk, it comes in two flavors. It comes as specific risk or trade-specific risk, where your counterparty is correlated with, strongly correlated, if not the same as some kind of reference. So it's like bank protection from bank protection on bank A from bank B, for example, right? So they are so very strongly correlated. Then if your counterparty, if bank A goes into default and you expect kind of windfall, then bank B will be close to default and you might not get it. So it's systemic. But there is another, and Basel 3 actually recommends just exclude these trades from calculation and just slap like the capital requirements for these trades will be just the notional of this trade. They basically treat this trade as a trades which always go into default and you lose everything. So that's kind of interesting. So, but the other type of wrongway risk is systemic, and that's kind of it's harder to notice and harder to quantify. It's when your counterparty is correlated with some market factors. Most often it's, or the best kind of example is FX. And if you, for example, go into cross-currency swap with some big local bank, and if you pay local currency and receive, say, USD, and then if this bank goes into default, there is high probability that this local currency will be devalued. So trade is in the money, and this is like classical. It's in the money. You expect to get a lot, and that's the moment when your counterparty defaults. So this is very big wrongway risk, and Basel III kind of is very specific that you have to identify and try to quantify this and include in models. So when you talk to regulators and show your models, you have to explain how you calculate wrongway risk, how you calibrate this. In my example, like correlation between FX. Here it's even like good question. What do you correlate? FX and credit spreads on FX and time of default of counterparty, because it should be FX and time of default. Or maybe you do something else. Maybe you introduce some jump of FX at default. That's another possibility. So you can model this in several different ways, but you have to convince regulators that you kind of quantify this adequately, and that you take this wrongway risk into account.
Thank you. Let's move to question number 2. Who's responsible for the management of CVA within your firm? Here we had 42% of the respondents say the central CVA desk, 4% trading desk, 25% credit risk department, and 29% shows multiple groups. What's the best practice in your view?
I would say I would merge A and C. I would merge to some extent central CVA desk and credit risk department in the sense if funding goes through them, or maybe give central CVA desk some kind of way of trading or trading or kind of establishing funding costs. That probably will be a holy grail, but a central CVA is definitely the right thing to do comparing with others, because you have ability to hedge your CVA risk across all asset classes. As I mentioned before, you have ability to net and apply collateral to the whole portfolio rather than per asset class. And that's kind of centralized view is definitely gives big advantage to all others. Multiple groups, I'm afraid even to think what that means.
Very good. And the last question, how prepared is your firm to meet Basel III requirements? Nobody has a complete solution in place.
Yeah, I would expect
surprisingly.
Yeah.
75% are in progress, and 21% have not started but plan to, while 4% have no plans for Basel III.
Okay, I'm surprised that it's 75. B. I would kind of expect between B and C to be maybe 50-50, right? But here we see that Basel solution is in progress. Of course, if you measure this progress, maybe it's very kind of beginning stage, 1 out of 10. But I think it's a good sign. I think banks realize that Basel III regulations will be coming, they will be there, and you have to be prepared. So you have to invest in infrastructure or invest in maybe some outside kind of solution, but you have to have a plan, and you have to start implementing this plan, and because you can gain a lot by optimizing this and by having some optimal hedges or optimal trades. Even when you do new trades, one can see that some of them are better than others because of choice of counterparties, or even if counterparties are similar, but these market factors kind of maybe of wrongware risk, or maybe of funding which they require, and so on. So having all these factors lined up and ability to compare them will allow you to make optimal solutions. So yeah, I'm pretty happy that it's 75% already feel that they start working on this and it's in progress. So I think it's a good sign.
Well, we have the most diligent financial market participants here at CVA.
Yes, sure.
Thank you very much, Dmitry, for being with us today, and we look forward to having you back. And
thank you, Alex. It's a pleasure to be here.
Thank you for joining us. The access link that you have used for the webinar will become the recording link within the next 2 working days. And please visit the webinar section of on our website to find our upcoming schedule of webinars. Thank you for joining us today. Have a good day, everyone.
Have a good day. Bye.
The organizer